In a few months, US government debt will hit $40 trillion. To put things into perspective, $10 trillion was hit in 2008, $20 trillion was hit in 2017, and $30 trillion was hit in 2021. This means that US government debt has been growing at an exponential rate. Contrary to popular belief, it's not just because of government spending per se, it's also because of the interest on this debt. Rising interest rates mean that all of the existing US government debt has become more expensive to repay, and the result is that a larger and larger share of the US economy is just going towards interest payments. This is not sustainable, and it could result in interest payments crowding out other payments like Social Security and Medicaid. And now a major federal agency is warning that this could happen in just a few years' time. And that's why today we're going to tell you everything you need to know about the US government's rising interest expense, how it could be reduced, and what could happen if it isn't. My name is Nick, and you're watching Coin Bureau Finance. Let's start with the big picture, because it'll blow your mind. In his book, The Price of Time, financial historian Edward Chancellor analyzed over 5,000 years of interest rates across different regions and cultures. What he found was that interest rates have historically been mostly arbitrary, and the same is true today, of course. Most central banks adjust interest rates to target 2% inflation, which is a target set by New Zealand's central bank in the 1980s, and one which became the standard in the 1990s. However, there was something that all countries had in common as it related to interest rates. When a country would form, interest rates would start off very high, and this makes sense because when a country is brand new, then it's considered high risk. And the only way that investors around the world will allocate capital to the markets and its economy is if the higher risk is compensated with a higher interest rate. As the country became stronger and more reputable, their interest rates would fall, as its larger and more liquid markets and economy would make it less risky, justifying a lower interest rate. But as the country grew old and weak, interest rates would rise yet again, as investors would start to recognize that the country is past its prime. Its markets and its economy will be smaller and less liquid. So, higher risk, higher rates. Thus, when you look at what US interest rates have been doing over the past few decades, you realize that what we're seeing is nothing new. Once upon a time, US interest rates were high and peaked in the 1980s. Then in the 1990s and the 2010s, US dominance hit its peak. As with past superpowers, this corresponded to record low interest rates, as well as record high standards of living that many Westerners now look back on nostalgically. And that's because US dominance has started falling. And now history is repeating, with US interest rates starting to rise, signaling the start of higher highs that will lead to the US empire's eventual demise. So that's the big picture. It's what everyone knows intuitively but can't quite explain. The only question then is when? How long until rising expense and interest rates cripple the US economy for good? The answer is something that everyone has been trying to figure out, including the Congressional Budget Office, or CBO, which is tasked with forecasting US debt and growth in an objective manner. And as I alluded to in the introduction, the CBO projects that by 2036, interest expense on US government debt will total 4.6% of GDP compared to 3.3% in 2026. Now, to bring you up to speed, economists believe that having interest expense at 3 to 4% of GDP is the danger zone, and the US has been in this zone since 2024. And this begs two bigger questions, and that's if the projection will change, and what will happen if it won't? Before we dive into the answer, though, you should check out our free weekly newsletter and check out some of our finance-related deals we have just for our viewers. Just click the link in the description and scan this QR code on the screen. And while you're at it, smash that like button if you're enjoying this video so far, and subscribe to the channel and ping that notification bell so you don't miss the next one. Now, back to the CBO. The CBO's 2036 projection comes from its annual report, which was published earlier this month. The report is titled, quote, The Budget and Economic Outlook 2026 to 2036. A neutral title, just like all the CBO's other reports. But of course, the media highlighted the fact that the US could be in deep trouble by 2036, and obviously the Trump administration called the CBO biased. In fact, this has actually been the case since last summer already, when the CBO was called in to help assess the economic impacts of Trump's so-called Big Beautiful Bill. The CBO found that it would increase deficit spending by $2.4 trillion over the next decade. Now, for those who don't know, deficit spending means extra spending that the US government can't afford to pay just using tax revenue. It's spending that will require more debt issuance. And what's crazy is that this $2.4 trillion figure was actually increased to a whopping $4.7 trillion in the CBO's recently released annual report, something that was also underscored by many media outlets. Naturally, many of them did miss the fine print. Trump's tariffs will actually offset most of this deficit spending over the next decade, resulting in a deficit of just $1.4 trillion by 2036, assuming the tariffs remain in place. And therein lies the reason why the CBO gets so much backlash and why its projections are so misunderstood and sometimes completely wrong. The CBO's projections in its annual reports are based on current data, on current fiscal and monetary policy. And that's why, if you look at the CBO's projections for things like inflation, GDP growth, and interest rates, all these forecasts look abnormally flat. And if you look closely, though, you'll quickly realize that inflation, GDP growth, and interest rates don't move nearly as calmly as the CBO projects. In fact, all three have been historically volatile in recent years. And given how fast the world is changing, it's safe to assume that these and other projections will be wildly different from what the CBO expects, particularly in the long term, where it's harder to predict what comes next. In other words, the CBO is literally taking what's happening today and assuming that it will continue happening for the next 10 years. Logically, what's happening today is guaranteed to change in the future, and the more that time passes, the higher the chances that it will change. I don't blame them, though. They are required by law to provide projections based on current policy, which, I'll repeat, is always changing and will change. And this is something that CBO Director Philip Swagel has reiterated in interviews with the media and his testimony on Congress. The CBO is committed to providing projections that are as objective as possible, but can only do this based on current policy. And what's wild is that they're apparently not even allowed to do things like model how much their deficit projections would change if the tariffs are fully struck down. Thankfully, Swagel is a true nerd, and I mean that in the most respectful way possible. He's obsessed with making sure his CBO projections are as accurate as possible, even though it's arguably a futile endeavor, since most of these projections end up being irrelevant or inaccurate. It's worth noting that this applies to short-term projections too. The CBO can't factor in any surprises like war or pandemics. But back to Swagel. If you go on YouTube and search for Philip Swagel and prioritize the results by popularity, aka view count, you'll find a video of an exchange between Swagel and Senator John Kennedy during Swagel's Senate hearing in 2024. It's well worth a watch if you have the time, because it's about what, if anything, the US government can do to change the unsustainable fiscal trajectory it's on. Swagel was initially hesitant to answer the question because the CBO is not legally allowed to make any policy recommendations. Put differently, they can tell US politicians that America is cooked, but they can't tell them what to do about it. But what's funny is that Swagel, in true nerd fashion, couldn't help but give a de facto policy recommendations after Kennedy pressed him for an answer to an empirical question. Swagel said that the best way to get the US government off its unsustainable fiscal path would be to cut mandatory spending, specifically spending related to healthcare and Social Security. Kennedy said that Congress would never allow that to happen, and then proceeded to ask how much overall government spending would need to be cut to stabilize this debt situation. Swagel said that it would be around 7 to 8%, which is a huge number. In plain English, the only way that the US government can get off its unsustainable fiscal path would be to cut overall spending by 7 to 8%, not just healthcare and Social Security, but military, education, everything. And that would just be to stop the debt from growing. Swagel stressed that even if this was done, the remaining US debt would still be enormous and would be extremely difficult to pay back. Just for a bit of context, 25 to 30% of fiscal spending, i.e. US government spending, goes towards Medicare and other healthcare-related costs. 22% towards Social Security, which includes stuff like retirement and disability benefits. 14% goes to military spending, and another 14% goes to paying interest on existing debts. And this is why Swagel and others want cuts to healthcare and Social Security. They're the largest slices of the pie. And it seems that Kennedy was wrong that Congress would never allow this to happen, because Trump's so-called Big Beautiful Bill included healthcare cuts that amounted to 10 to 15% of the fiscal capital being spent on healthcare. Now, for reference, it's more than double the spending that Swagel unofficially advised in his 2024 hearing, presumably because it's intended to negate the need for cuts to Social Security. Put simply, the Big Beautiful Bill cut healthcare spending by 10 to 15%, which is roughly the same as cutting both healthcare and Social Security by 7 to 8%. And this could just be a coincidence, but it doesn't change the fact that to get back on a sustainable path, the US government still needs to cut 7 to 8% from everything else, namely military spending and interest costs, which you'll recall make up most of the rest of the pie. Well, the Trump administration increased military spending last year, and it looks like they're going to be increasing it again. Trump has publicly proclaimed that he wants military spending to increase by another 50% in 2027 to build a, quote, dream military. If these plans are approved, it would make military spending roughly as big as Social Security and healthcare, which is completely unsustainable. And this brings us back to the interest part of the equation, which Swagel has admitted is the hardest part for the CBO to forecast. At first glance, you might think that interest rates depend on things like unemployment and inflation, because these are the things that the Fed looks at to set interest rates. In theory, if you can accurately forecast unemployment and inflation, then you can forecast interest rates. In practice, this is a lot more difficult, and not just because forecasting unemployment and inflation is itself difficult. You see, when the Fed or any other central bank adjusts interest rates, they're just adjusting short-term interest rates. Longer-term interest rates depend on the supply and demand for US bonds, because US bond prices determine bond yields, and bond yields determine long-term interest rates. Upon closer inspection, you understand that everyone pays a lot of attention to the demand for US bonds, but not enough attention to the supply and almost no attention to the duration of this supply. On the one hand, yes, there is less demand for long-term US government bonds. On the other hand, however, the US government has been issuing far fewer long-term bonds and more short-term bonds. And this not only helps to reduce the impact of, say, countries like China buying fewer US bonds, but it also makes it possible for the Fed's short-term rate to have a bigger impact on the cost of interest for the US government. By shifting most of the US bond issuance to the short end and having the Fed cut short-term interest rates, it becomes possible to significantly reduce interest expense eating away at the fiscal pie. And if you watched our recent analysis of Kevin Warsh, Trump's pick for the next Fed chair, you'll know that he's planning on cutting rates and reducing the size of the Fed's balance sheet. The practical effect of the former would be to lower interest expense if the US government keeps shifting bond issuance to the front end of the curve. And the practical effect of the latter could cause longer-term rates to rise. And this is where the famous quote from economist Thomas Sowell comes in handy. There are no solutions, only trade-offs. And as it relates to Fed policy, it's believed that Warsh wants to reduce the size of the Fed's balance sheet in part because it will make other Fed governors more likely to vote in favor of a cut in interest rates. But, as I just mentioned, shrinking the size of the Fed's balance sheet would also have bad consequences. And the same is true when it comes to government spending, and the recent healthcare costs are a perfect example. While cutting healthcare by 10 to 15% means the US government saves money, it also means that the average American either has to spend more money on healthcare or doesn't spend the money because it's too expensive and ends up getting sick or even dying, resulting in less economic growth. For those unfamiliar, around a quarter of all economic growth in the US comes from public spending. So, when the US government spends less, either the private sector needs to spend more to make up the difference, or else economic growth will fall. And this is precisely why both the public and the private sector are praying for a productivity miracle, because without it, it won't be possible to grow out all of that debt. In sum then, if the US doesn't cut spending, then debt will become unsustainable and the economy and the markets will suffer. But if the US does cut spending, then the economy and the markets will also suffer because so much of the money flowing through them is coming from the government. And this brings me to the big question. And that's how the US will get out of this seemingly unsolvable situation. The answer is a word I'm sure you've all probably had on your mind from the beginning of this video. Inflation. When countries get into the kinds of situations the US is in now, the only solution is to inflate away the debt and the obligations. So yes, you'll still get healthcare and social security benefits from the government, but over time, they will be worth less and less in real terms, something that many beneficiaries can already see and feel. And this creates another problem though, and that's perception. As a random but related fun fact, it's not poverty that causes crime. It's relative poverty that causes crime. When people can see that others have more than they do and they get the feeling they can't get ahead with legal means, they start trying to do it illegally. And this is why the growing wealth gap is so disruptive to society in the US and elsewhere. Fortunately or unfortunately, many people in the US and elsewhere have started noticing that the only way to get ahead is to invest in assets that retain their value in real terms, that keep up with or exceed inflation. And this means assets that have a supply that grows more slowly than the supply of fiat currencies. And that includes everything from real estate to gold and even maybe Bitcoin. Although investing in these assets seems like a solution, it also presents another problem, and that's the fact that many wealthy individuals and institutions use these assets as collateral to borrow money. And that's because if you borrow against your assets, you don't pay any tax, in most jurisdictions anyways. Newsflash. This creates more debt, in this case private debt, which presents similar risks to public debt. Take gold, for instance. Everyone knows that gold is the ultimate inflation hedge. It's the easiest and most convenient way to preserve your purchasing power over time. However, nobody mentions the fact that hundreds of billions of dollars have been borrowed using gold as collateral, and that's according to official statistics. Unofficially, the figure could be much higher, possibly in the trillions of dollars. What this means is that if gold's price starts to fall, then any over-leveraged players get liquidated. The gold they used as collateral gets sold on the open market. This pushes gold prices further down, causing more liquidations, and so on and so on. And what does this gold get sold for? That's right, US dollars, so that the debts can be repaid. Now, imagine this leverage at a systemic scale, using real estate, bonds, etc., as collateral. And this is what the state of private debt looks like, at least in the financial markets. The silver lining is that whenever this leverage unwinds, central banks and governments step in to spin it back up. And this presents an amazing opportunity not just to buy quality assets at a discount that gets liquidated from over-leveraged players, but profit on the appreciation of the US dollar as these assets get liquidated to pay down the debt. Say, have you noticed that the Dixie has been in a big accumulation range over the last year? Surely it's not about to rally. After all, everyone is reportedly short. That could trigger a short squeeze, right? If you answered no to all of the above, then check out our video on whether the BRICS countries could defeat the US dollar with gold using the link right over here. And if you made it this far, then thank you very much for watching, and I'll see you in the next one. This is Nick, over and out.